Elavarukkum vanakkam. I know a little bit of Tamil, but I will not take that, effort of doing a presentation in Tamil. So I don't want to make it look very difficult, but I will try to make it as simple as possible. Honestly speaking, multi-factor investing is what I'm going to talk about. Of course, there is a selfish interest because we are going to launch a multi-factor investing fund in the month of November. So I have a little bit of selfish interest about it. But again, honestly speaking, this is also new to me to understand a little bit more about multi-factor investing. Initially, when I was listening about multi-factor investing from a lot of fund managers, it was going above my head. Even at least for 4 or 5 times I had to hear them that what they are talking about, and then only I could make a little bit about it. But I will try to make it as simple as possible to all of you, because that is what is required. When we go in front of investors, we should at least be able to explain to them what it is, and we should not make it very complicated, and that is what is my job here. So before I get into multi-factor investing, let me create a context to it. We all know that, it took a lot of years for us to invent mobility, and when we invented mobility, or maybe 500 years or 1,000 years, that we had seen various versions of mobility. And today, when we talk about mobility, we are talking about a vehicle which is not just a mechanical vehicle, but it is driven by technology. So it is not that just the invent of wheel. Of course, the invent of wheel actually created a lot of innovation in mobility. But today we are at an age where mobility is completely taken over by, not by mechanical parts, but mostly by technology. So when you compare these two, when you look at the old version of a car to a new version of car, initially, of course, what we need is a very qualified or a very technically qualified driver, because the car was a very mechanical object. So you need somebody who knows. Suddenly, if it breaks down somewhere, he needs to know what is the problem. You will have to at least have some basic knowledge of how to rectify it. But today, what you need, it has become autopilot, right? Today, you don't need a driver. In many countries, there are driverless vehicles already available. Tesla is one of them. They are trying to launch it in India as well. But there are already innovations which are happening in the world where you don't need a driver to drive a vehicle today. Machines are so. If earlier when you get some defect in a car, what you do is you take to a mechanic shop. The mechanic will you will open up and he will see what is happening inside. But today that's not the case. Today most of the modern cars you take to the service center. They connect a computer to the vehicle, and then they diagnose what is happening in the vehicle. So today technology has taken over. It's not that they have to open the whole vehicle to see what is happening inside. They can just plug in to a computer, and then they can understand what is happening inside that. The productivity is very high, plus the surveillance. If you don't put a seat belt, it will keep beeping. If your fuel is going to get over, it will keep indicating. If you go a particular speed, above a particular speed, it will start showing you the indication. So everything has become mechanized and automated. So that has made our life much more easier, that we know that at every point of time, what we are doing, there is some sort of indication, and the technology has been developed in such a way that we are able to do all that. So all these have been reducing or maybe making the life simple for driving, or maybe in terms of mobility. Are we adopting similar investment technologies into our investments is what is the context that I wanted to build, because many a times what we get to hear is we get to hear a lot of fund managers, and of course I am sure before me there was a fund manager who spoke about the fund, and there most of the time what we get to hear is what the fund managers' views are in terms of markets, in terms of economy, in terms of stocks, in terms of sectors. But that is again coming from one person individual's view in terms of what they feel is the market going forward. But is there a different variant of approaching the investments? Of course, there is. Worldwide, technology has taken over the investment decisions as well. Like the way I said, the mobility has been much more simplified by using technology. Even investments also has got simplified, or they have also been, improvised over time using technology. And that is what we are going to talk about, which we basically call it as quant strategies, which is basically quantitative strategies, which is use of technology, artificial intelligence, mathematical models, data-driven investment decisions, and that is put across to improvise and create some sort of robust investment models for making investment decisions. So that is what basically is a quant strategy. How is it? And quant strategies are basically not human versus technology. It's not that this technology is going to take out all the fund managers from the picture and it is going to be technology which is going to take over the investment decisions. But it is going to be a collaboration between technology and humans. Like the way I said, if you are driving a car today, maybe 50-60% of the technology of the car will make your driving more easier, but still the driver has to use 30-40% of his effort in terms of making that driving smooth. Similarly, in investment decisions also, we may have to use a mix of technology with the human effort to make it more robust. So it's not human versus technology, it is basically a collaborative effort between humans and technology, and that is what we talk about quantitative investing. Traditionally, what we basically do, if you look at the fundamental way of investing, we study the financial statements, we meet the managements, we try to understand what is happening in the economy, what is our future outlook to the economy, what is the future outlook for a particular company, what is the future outlook of a particular sector, and we project saying that, okay, if these are my assumptions, probably this is the way the investments will go, or maybe probably the profit of this particular company will go and the stock price will also behave in such a way. And that is how we typically try to forecast the returns that we can generate from certain sectors and stocks, and that is how the portfolio constructions are done. So that is basically what we do in terms of a fundamentally research-oriented company. But when it comes to active quant strategy, basically it's data, it is using of stock picking basis, of course basis macro. All those macro elements that I spoke about will all go into this process. But beyond that, there is a very scientific approach in terms of mathematically deriving what is the potential of a particular company, where does it stand, what is its risk, how much of risk that particular company has. Everything can be quantified mathematically, and using that, constructing portfolios through mathematical models is typically what they do. And this can be only done through very robust, strong, platforms, or typically technology platforms, which can actually crunch a lot of data and then provide you with that outputs. How is it different from fundamental investing? Again, this is complementary. It is not that quantitative investing is it's superior to fundamental investing. No, fundamental investing is a type of investing which we have seen for so many years. It has been able to create alpha. It has been generating alpha for a long period of time. So it is not that fundamental investing is out of fashion. But now that we all talk about data, we talk about artificial intelligence, we talk about technology, this is also a style or a type of investment that is coming up, which is actually been adopted worldwide for quite some time, and thereby they are able to help, or they are able to provide a slightly better, or that style of investing is also able to create alpha for investors. So it is actually a complementary style of investing which we can look at. Just to give you a little bit of difference between these two, fundamental investing, as I said, is basically company fundamentals and management is what is the key, and that is what fund managers basically look at. Whereas in this case, it is company financials, data, algorithms, and large data sets, and all that, the technology which we can actually use a lot of data in terms of understanding how to look at a particular company. Time horizon, generally when fund managers talk about long term, right? They always talk about a 5-year, 10-year, 15-year, 20-year period, whereas this data, you can even look at medium term type of investing. You don't have to be actually looking at long term. We can also construct portfolios for a medium term and short term, and whichever way you want to construct, you will be able to do it at that way. Risk management, typically fund managers' qualitative assessment is risk management, right? Whether a company is good, bad, ugly, of course there will be some parameters. The fund managers' qualitative assessment is what is the key to assess how a particular company is. But while you are applying data, probably you can quantify risk to a number. So this is not qualitative assessment. You can quantify each and every element of risk mathematically, and that is why the role of data comes in, and that is how these type of platforms becomes extremely robust. Human bias is minimal, as I said. This is more of technology, very less use of human. So the data is what will give you the outputs. The role of human is less, whereas in the fundamental investing, the role of human is much higher. Of course, technology here, it uses much more advanced AI and robust platforms to analyze data, whereas in terms of fundamental research, the use of data is very limited to some sort of analytics in terms of using to understanding some of these ratios and some of those parameters. But here the use of data is very high. There the use of data is very minimal. Number of stocks will be relatively higher. Whenever you talk to a fund manager and whenever you talk to any fund house, they say that they basically cover, say, 250 stocks or 300 stocks, because that is only humanly possible. You will not be able to analyze 100 stocks, 1,000 stocks, 2,000 stocks. It's not humanly possible to analyze all those stocks. Whereas when you are putting it through technology, it is possible to do large number of stocks if you want to, because now it is a machine which is doing and it is not a human which is doing. So we will be able to actually analyze more companies. It can increase coverage. The return profile, typically what a fund manager tries to do is to outperform the benchmark and try to give you slightly higher differentiated returns through sector, overweight, underweight sectors, overweight, underweight certain stocks, and that is how they try to create alpha. But here it is completely through stock selection, and here what basically these models try to do is to how can I minimize risk while creating alpha? Can I create alpha at a much lower level of risk? So that is what basically they try to look at in this type of quantitative models. So there are a lot of such styles across the world, though in India this is a very nascent thing. We have started talking about quant models. We are talking about quantitative models very recently, maybe in the last 3-4 years or 5 years probably we would have started talking about quant funds and quant models. But globally it is very popular and it has been there for quite some time. And there are various different styles of investing, right? There are quantitative equities, sustainable equity where we add some sort of an ESG element to it. There is core equity, active equity where they go for very high, tracking error type of investing. So there are various different types of quantitative investments globally. Whereas in India, it is slowly coming up, and maybe probably in the 4-5 years, there have been some attempts to do it. But when I talk to a lot of my competitors in the market and they try to understand how they adopt, quantitative investing, most of them are in that, trial and error mode, because they have created certain models. They are working on that models. They are trying to see, they did some sort of back testing. They are trying to see that whether that models will work. And in certain markets, the models are working very well. In certain regimes, we call it as regimes. When the market changes, we call it regimes. In certain regimes, the market, they are not doing very well, because it is very, so whenever we talk about data, like for example, I spoke about Tesla, which is using a driverless car. Now for Tesla to introduce a driverless car, probably they would have taken 10 years of research in terms of how that will work in various conditions, various road conditions, right? So the data that collect over a long period of time, that will improvise that how they approach various situations. Similarly, whenever you are using data, you need a large set of data, number one. You need to have a long period so that you have time tested it in various regimes and market cycles. So what is very important to all of us is that we need to have robust platforms, and that platforms has to be time tested over time, so that it has seen many market conditions, and in various market conditions probably it has been able to create alpha for investors. So how do you bring this science and art together? Of course we need to have a multi-factor exposure. I will speak about this multi-factor a little bit more. Of course it has to be a very systemic approach. It is driven by systems, and there will be a little bit of human professional expertise also will come in, and that is why we call it as an active quant. So quantitative strategies and a little bit of human effort to it is what we call it as an active quant strategy. And we believe that active quant strategies are the way that we can approach this type of investing going forward. What is our core belief around this? The core belief is that any quantitative strategy should be grounded and validated with fundamental economic rationale. So all these years, so just to give you an example of Franklin Templeton, we have been doing, we are into investments for more than 77 years now. And globally, Franklin Templeton doesn't do any other business other than investment management. So we do different styles of investment management, but we don't do anything else. We are not a bank, we are not an insurance company, we don't sell credit cards, we don't do anything else. Anywhere in the world Franklin Templeton is present, we only manage assets of investors. Now, all that expertise of what is required to look at while we look at investing, what are the parameters that we have to look at, all that has been collected over the last 70 years, and that has actually gone into creating this set of a fundamentally economically rational type of a model. It has to be rigorous, it has to be unbiased. When I say rigorous, we use a lot of sub-factors. Every factor has got a, expiry date. Some of those factors will get decayed. We need to research new factors, you need to create new factors so that the effectiveness of the model continues to be robust. That needs to be a continuous effort. It cannot be one time, it has to be a continuous effort. So it has to be robust, it has to be unbiased, and it has to be transparent and rigorous. So four basic factors that we mostly talk about are this. I am sure many AMCs have launched single factor funds. There is some momentum 30 fund, there is some low volatility fund, there is some value oriented fund, there is some quality oriented quality 30 fund. So there are single factor funds, there are quite a bit single factor funds. But our view is that, of course, we have been doing this for quite some time, and then thereby we felt that a single factor has got certain merits, but at the same time they have got certain disadvantages because various factors works in various regimes. Like, for example, if the markets are falling, probably a high quality factor will do well. But when the markets are in a recovery phase from a fall, probably value will do well. But market continues to move up and then it gets into a bull run type of a situation, momentum catches up. Low volatility will come when the markets have reached a peak and it has started coming down, probably a low volatility will do well. So, see, every factor has got a regime where it does very well, but there are other regimes where it doesn't do well at all. So if you look at one single factor, you have to be very sure. This is something like a sector fund, right? You have to know when to enter and when to exit. And if you don't enter at the right time and if you don't exit at the right time, probably sector funds doesn't give you that the best result. Similarly, when you look at single factors, if you are not coming at the right time and if you are not getting out at the right time, probably it is not going to actually add much value to you. So in that case, it becomes much more difficult for us to know when to enter, when to exit, and how to guide our investors when to enter, when to exit. And that is why we feel that a multi-factor approach is always better. Just to give you a little bit of example, if you look at these three regimes there, the one between January 2020 to March 2020, when the COVID fall happened, quality actually stood much better than when everyone fell, but quality factor didn't fall much that high. When between April 2020 to December 2020, you saw the market actually picking up, or maybe from the fall, the market started slowly going up. Then we saw that the value picking up. And in between April 21 and March 22, you saw the market actually, recovering quite a bit from the COVID fall. We saw the momentum picking up. Now, you look at that, the period of every regime is not 1 year, 2 year, or 3 year. Typically, we talk about market cycles of 5 years, right? But when you talk about market regime, in such a situation, if you look at, there are like 2 months, 3 months, 6 months type of regimes. The regime changes are happening so frequently, and in that case, you are just in one single factor, probably you may get caught there. Similarly, we always say winners rotate. We have seen heat map of asset classes rotating, equity doing well in 1 year, maybe debt doing well in next year, gold doing well in some other years. So we have seen this type of heat map. We have also seen between large cap, mid cap, small cap. We have also seen heat map between economies, right? India doing well, China doing well, US doing well. So we have seen all that stuff. Similarly, when you look at these styles and factors also, you see that there is no one single factor which actually delivers the best return across periods. So you need to be available, and just because that there is no one single factor, it is difficult to say that, okay, if you are in value, you will be taken care of for a long period of time. If value is the best factor, there is no one single factor, so then definitely you have to be in multiple factors. And then you also have to know when these factors and regime changes. Can you predict these regime changes slightly ahead of that regime changes? And that can only happen through data, and that can only happen through mathematical models when you put last 15 years, 20 years, 100 years data and process and patterns are built, then you will be able to say that, okay, this is how it is and this is how the patterns are, and probably going forward, you will be able to do that. Everyone use algorithms, right? Everyone use, algorithms, and everyone use AI. Today, even if you go to Netflix, you see a movie, immediately they will show you 4 movies saying that, okay, if you watch this, these 4 movies will be, you may like these 4 movies. Immediately the algorithm work in between saying that, okay, this person's preference is this, probably this 4 may be of his liking. Similarly, everywhere algorithms are working. In the internet world, in the technology world, algorithms are very, very popular. Similarly, in investments also, you can do predictive analysis, right? You looking at the trend, last 100 years trend, if you decode the 100 years trend mathematically, you will be able to say that, okay, this is how the patterns are, and probably these are the patterns that is going to emerge. And if these are the regime change, probably is it momentum which is going to pick up steam, or is it going to be low volatility, which is going to be quality, or should I be staying in value? Should I be overweight, underweight, any of these factors? All that will come up through mathematical models, and that is possible through mathematical models. Again, to give you a little bit of perspective from every single factor, this is the quality factor. If somebody is staying invested only in quality for a long period of time, you can see that there has been good times and bad times. The highest drawdown has been 10%. So the highest fall in that over the last 15 years has been 10%. Value though has actually delivered extreme results. It has seen very good upside and downside. You can see that they have had the highest drawdown of 20%. Similarly, if you look at momentum, growth, low volatility, everyone had their own good times and bad times. It is not that any one single one has been the winner. But when you look at it as a combined way, probably the drawdowns can be reduced quite a bit. So drawdown, if it is like 10, it ranges between 7% to 20% across various factors. But as a multi-factor approach, it can be reduced as low as 0.68 or maybe less than 1%. So it try to reduce the risk significantly of investing when you look at from a multi-factor approach. That is happening because there is definitely negative correlation between factors. It's not that every factor work at the same point of time. When momentum is doing well, probably value is not doing well, or low volatility is not doing well. When the markets are correcting, the momentum stocks goes down. So typically you don't find some of those, you may find some of those value and low quality actually doing well. And that is because they have got negatively correlation between them. So it is all key to understand which market phase is about to follow and how can you predict that market for market regimes, and how do you position yourself for that. Multi-factor investing, again, there are multiple, like just to give you an example, I'm not going into detail of all this. Next week our fund manager is going to be here, I think on the 3rd of November. I'm sure he will be able to explain it much deeper. I'm not making it very technical. But just to give you a little bit of an example, so we have a category called the Balanced Advantage Fund, right? In Balanced Advantage Fund, typically every AMC does 2 factors. One is a PB and PE, price to earnings and price to book. These are the 2 factors that basically they use. And the asset allocation is completely derived by these 2 factors. If you are using only 2 factors or 3 factors, it is easy for you to manage it and create it. But what if you are using 40 different sub-factors? There are 40 different data sets which gives you inputs, and you need to analyze each and every input to actually derive scores for every stock. Then it becomes very difficult to do it individually. And that is why today I said in India many quant models that is running, they run on an Excel sheet. On an Excel sheet you have a limitation of a few factors, but the moment the number of factors actually goes up, then you may need a robust model to do it, and that modeling has to happen over a period of time. So this is how it is. Basically, we take all the 4 models, we take all the stocks which is available in this, we try to put that into 4x4 metrics, whereas basically we try to score every stock based on its sector, its size, its risk, its style. Of course, there is some sort of relative ranking from +3 to -3. If a company in a particular sector is very small, that will become -3. That means that is the lowest. Or it is the biggest in that sector, it will become +3. So likewise, for every company, there can be score for its style, for its whether it is a growth company, whether it is a value company, whether it is a momentum. All that can be considered and scored and ranked. And based on that, you create scores for every stock. Then you take the final scores of all the stock, you construct portfolio, and then you operate. Though I am telling you it's very simple, but the way through which you code this and score this is not very simple. It is done through very rigorous mathematical models. I am just trying to make it as simple as possible so that we all can understand that. I said from a return risk perspective, it actually tried to minimize the risk. The drawdowns have been much lower. But from a return perspective also, it has shown that over time, it has been able to create significantly decent returns, almost 4% alpha over a period of 20 years. And then the risk has been much lower than the index, which is BSE 200. Sharp ratio has been better. And of course, the tracking error has been very minimal. Again, if you look at from a returns perspective, if you look at calendar year returns over the last almost 15 years, only 1 year there has been a negative returns, or maybe a returns which is lower than the benchmark, but all other periods it has been able to create alpha. When you look at from an annualized basis, across all time frames, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 15 years, it has been able to beat the benchmark and create alpha for investors. Again, if you look at from a rolling basis, returns basis, also these funds have delivered, this type of modeling has actually helped. I would like to look at that last, in the 3 year rolling returns. If you see about 20% returns, the index has been able to give only 13 times. It has been able to give about 20% returns, whereas the model has been able to give 42% times. Same in the 5 year returns, it is like 6% times the model has, the benchmark has given about 20% returns, but the model has been able to give 26 times. Now, if you look at from any type of analysis, this try to provide you, I'm not going quite detailed. There is a presentation booklet. There is a presentation. If you want to see, all these slides are there. You can see what has been the drawdown, what has been the tracking error, what has been at various regimes, how it has performed. All that has been done. Now, I would like to leave only a few thoughts here. Recently, I'm sure you would have heard about an AMC which has been talking about a platform and then collecting money through data-driven investments completely online, right? It has been very successful. Similarly, these type of models are present already across the world. Franklin Templeton has been running quant models for more than 20 years. It is managing for more than 70 large investment bank mandates across the world, because this is very popular worldwide. And we are not trying to do anything new. We are not trying to say that, we are going to do something new with quantitative technology. We have been doing it for more than 20 years. What is that is required for a successful quantitative to be successful in this type of investing is that, one, you need to have a qualified team. Second, you need to have the expertise. You need to have the data, and you need to have that capability in terms of running it. Franklin has been running it for more than 20 years worldwide. We are only trying to bring that capability to India. How are we different? Of course, we have the global expertise. I said we have got more than 20 years of experience in running it. The team is supported by a group of data scientists, a group of factor research scientists, and then a group of fund managers, and all the three come together in terms of creating these funds. It has been already happening. It's not that we are doing it for India. Even in India, so out of almost $60 billion that we manage across the world, in emerging markets, we manage close to 2.5 lakh crores, which is like 28 billion, of which 15% is India, so close to 1 billion. So we do something like 9,000 crores of money is already managed through these models in India for global clients. Of course, in India, we are launching it first time, but there are global clients who use these models, and we are already working for them. So these are models which is already in place. Even in India, Indian stocks, it is already in place, and we have been doing all this. It is not that we are going to do anything new, but we are already doing this. We are only trying to bring that expertise to our investors in India. So basically, we have a continuous factor research team. So that is what I said. I said 40 plus factors is what we use, but that 40 plus factors needs to be researched constantly so that no factor has to go out of fashion, and we need to actually bring robust factors. That there is a factor research team. We limit conviction bets. It's not basically on conviction of any individual. It is basically the model. Invest large across factors to avoid factor bias, and then minimize stock bets. focus on stock selection. So here we don't basically look at sector bets. It is not that we try to create alpha by buying some sectors overweight, underweight. Here mostly it is through stock selection, and stock selection happens through rigorous mathematical models. So that is where I will leave the thought today. So we are definitely coming out with a multi-factor fund in the month of November. It will be very interesting to look at it. The reason why I am excited with this product is that this is run by the Franklin Templeton global team. So the thing is that we have a separate team to do it. It's not that same Janki Raman who is running a FlexiCap is going to run a fund on a quant model as well. This is run by specialized teams who have been doing it for more than 20 years for more than 70 mandates worldwide. So the people who have got expertise, who have got international exposure to run it, are the people who are running it. This is already an expertise which is there in place. It is very popular worldwide. Maybe probably in India it's something new. And we also use a very robust platform. So we also have a platform called Mosaic, which is a proprietary platform which is used for more than 20 years, which actually helps to put all the data, create all that, and try to provide execution easier. So it's not an Excel-based working that we will go put everything to Excel and then try to pull out something out of this. We have invested quite a bit in this. We have been doing it for a long period of time, and hopefully we should be able to create alpha for our investors as well. So I would like to thank everyone for taking time out to listening to us. Do I need to take any questions?
Thank you, Praveen. Any quick question? All of them know multi-factor and also about automobiles.
If everyone knows multi-factor, then makes my life easier. I have to just come and ask for money, that's it.
Thank you. I'll invite Mr. K. Raja to come and honor Mr. Praveen. No, he's not K. Raja. Are. K. Raja, come forward. No. Okay, Bhaskar. Bhaskar from Vellore. Kadalur, no problem. Kadalur is good. Please come to the center. Thank you, Mr. Raja. Thank you, Mr. Praveen. So we'll break for tea now. Request everybody to be back by 6:05.